on the weak side, leading indicators are still falling. They've been falling for, I think, 2 years. Leading indicators, when I started in the business, if they were down 3 months in a row, then the probability of recession was very high. So there is something in the underlying economy that is not well for the leading indicators to continue down. We also saw deflation in the manufacturing sector, the ISM prices paid. So that's a sign that not all is well in the manufacturing sector. In fact, most of the cyclical parts of the economy are falling.
In the video, Cathie also discussed the recently released September jobs report. According to the latest data from the U.S. Labor Department, the economy added 254,000 jobs last month, and the unemployment rate fell to 4.1%. Experts view this report as a significant boost for a labor market that has displayed signs of weakness, especially since it surpassed economists' expectations of 140,000 jobs, with the unemployment rate predicted to remain steady at 4.2%. While individuals like Summers lament the strength of the labor market, Cathie highlights that the report sends mixed signals, with various sectors of the economy still showing signs of weakness. She expressed particular concern about the manufacturing sector, which is a key indicator, noting that it should exhibit more signs of improvement if we hope to avert a recession in 2025. Here are more clips from the video. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
This is the Fed funds rate versus the headline CPI on a year-over-year basis, percent change. And here you can see, well, it's a chart that has influenced me since the early days of my career. You'll see in the early days, in the late 70s, early 80s, the green line, which is the Fed funds rate, went well above the purple line, which is the CPI inflation rate, and stayed above for the most part until the tech and telecom bust. And since then has been at or below the inflation rate until recently. Now it's above. And if we're right, that inflation rate will continue to decelerate, which means that it will go further and further below the green line, the Fed funds rate, all other things equal, which means that Fed policy, real rates, as measured by real rates, is very tight. And I've heard after today's employment report, and we'll get into that in a moment, a lot of forecasters, strategists, economists are coming out and said, oh no, they cut by 50 basis points. That was way too much. This chart would say absolutely not. It's not too much. In fact, if the inflation rate continues to decelerate to zero or below zero, as we believe it will, then monetary policy will be increasingly tight. And we think the pressures will be on in the economy. So we do expect the Fed funds rate to continue down. I saw Governor Goolsbee, Chicago, reinforced that the trajectory is down. And what's interesting about that is if the Fed says to us rates are coming down and will continue to come down, then what is the incentive? The incentive is to wait and see how low rates go. Same thing with prices. If prices are coming down and discounts are going up, the incentive is to say, okay, let me see how low is low. So we may still see surprisingly weak growth in the months ahead. Here you can see the Conference Board Consumer Sentiment Index, and it's actually Conference Board's Consumer Confidence Index in the green, and the University of Michigan's Consumer Sentiment Index in the purple. The green, the Michigan survey, tends to be a reflection more of inflation than anything else, while the conference boards tends to be more of a measure of employment. So you can see inflation coming down has helped sentiment in the University of Michigan survey, although if you look at it in the context of history, this level is still a very low level in historical context. In other words, the consumer is not that optimistic. Now, the conference board, on the other hand, because employment had held up so well, at least headline employment, had been looking much better in the context of history. But now we're seeing we're seeing many labor indicators come down. And we're beginning to see the conference board break down as well. The latest month I don't think is on here, and it came down fairly significantly. I think it went to 98.
In the video, Cathie also discussed the recently released September jobs report. According to the latest data from the U.S. Labor Department, the economy added 254,000 jobs last month, and the unemployment rate fell to 4.1%. Experts view this report as a significant boost for a labor market that has displayed signs of weakness, especially since it surpassed economists' expectations of 140,000 jobs, with the unemployment rate predicted to remain steady at 4.2%. While individuals like Summers lament the strength of the labor market, Cathie highlights that the report sends mixed signals, with various sectors of the economy still showing signs of weakness. She expressed particular concern about the manufacturing sector, which is a key indicator, noting that it should exhibit more signs of improvement if we hope to avert a recession in 2025. Here are more clips from the video.
We had non-farm payrolls at, I think, 254. They were up 254,000. The expectation was about 150,000, and the past 2 months were revised up by 72,000. So upward revisions are a good thing. Now, we had been seeing downward revisions for quite a long time. So this is a departure, and we must take note. I will also say that, the indicators that were strong were healthcare, education, government primarily. If you looked at cyclical indicators, exceedingly weak, still exceedingly weak. So that's non-farm payroll. The unemployment rate, so the headline number, actually ticked down from 4.2% to 4.1%. Many thought it would tick up. It did not. And then the average hourly earnings were a bit stronger as well, 0.4% month to month. Expectation was 0.3. So average hourly earnings are going up 4% on average per year. Productivity, it seems, is in the 2.5% to 3% range. So what that means is if average hourly earnings are at 4% and productivity 2.5% to 3%, then the underlying inflation rate is in the 1% to 2% range, probably. So that's good. It's good that wages are going up as productivity goes up. Corporations are sharing some of the wealth. On the negative side of the unemployment rate, the manufacturing was down, temporary help was down. Temporary help's a leading indicator, but it's been coming down for a very long time, so it hasn't been much of a leading indicator. Hours worked were down about 0.3%. So that takes away from some of the very positive statistics. And if you looked at the ISM service report this week, employment in that report was surprisingly weak, just like in the manufacturing part of that report. So again, conflicting indicators. in terms of the week-to-week initial claims, those have surprised on the low side of expectations. This week, JOLTS, so job openings, those surprised on the high side of expectations after coming down fairly dramatically. So that was interesting. And I guess the only other variable on the labor side was the Challenger layoff survey. That shot up 53% on a year-over-year basis. So we know there are layoffs. We read them in the newspapers, and they are up 53% on a year-over-year basis. So in terms of, I'm now going to separate just in the last month, just the balancing act that's going on here in the world of economic statistics. So household net worth, the change in net worth, that was up very strongly. The stock market has been up. Home prices have been up. Those are the two biggest indicators. Now, if you look at both of those in the stock market, market concentrated towards very few names, that's not a great indicator. We prefer to have it broadening out. And in the housing market, while pricing is up, the actual units sold, units started, have collapsed and have not come back.
In other news, JP Morgan analysts are optimistic about October for the cryptocurrency market, according to a report released on Monday. The analysts highlighted historical trends, noting that Bitcoin has recorded positive returns over 70% of the time during this month. The report stated, while past performance is not indicative of future results, we believe the popularity of October may influence behavior and lead to a positive month for Bitcoin. They identified several key developments that could contribute to favorable performance in the cryptocurrency market this month. These include the Federal Reserve's recent rate cut announcement and expectations for additional cuts during the November and December meetings. The report also emphasized the potential effects of U.S. regulators approving BlackRock's spot Bitcoin ETF, which would allow for options trading. This development provides options investors with a more dynamic way to engage with the ETF, potentially driving liquidity in the underlying asset. Additionally, the JP Morgan analysts expressed enthusiasm for Ethereum's upcoming Spectra upgrade, which they believe could significantly enhance Ethereum's functionality and price in the long term. They concluded by noting that the crypto ecosystem is increasingly sensitive to macroeconomic factors and that they are awaiting the next major catalyst for development and increased retail engagement to foster sustainable growth within the ecosystem. Are you noticing any signs of this potential growth? For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.